Good afternoon, everyone. Thanks very much for coming. A lot of familiar faces and maybe a few new ones as well. For those who don't know me, I'm Michael Gordon. I am the Acting Chief Economist for Westpac. Down the front here we have Imre Speiser, who is our market strategist. We use this session to talk a bit about some of the key themes in our latest report, which you'll have on your chairs or under them or somewhere around you. I'll talk through some of the key themes from that report. Imre is then going to come up and talk about what he's seeing going on in financial markets and what we're looking for in the months ahead. So the title for this one, Weathering the Storm, as is sometimes the case with these, the title's serving double duty. It's not just about the recent weather that we've had, although we did have made an early attempt at trying to get a handle on that. It's also about the economic storm that we're expecting for the year ahead, and in particular, what homeowners will need to be riding out. There we go. So one of the key things we focused on this time is that it's going to be a tougher year ahead, in particular for mortgaged homeowners. And that's as we see an increasing number of people rolling on to mortgage rates that in some cases are going to be substantially higher than what they're coming off. Now, this is not a new issue by any means. We've known that it's really just a matter of time. It's in terms of when it hits home. And in fact, we've been pretty frequently and updating our estimates of this for the last year. But what really matters this time is that it's coming to that crunch point where you're going to have a lot more people going on to higher rates, and also the degree of change is going to be markedly different. And as time has gone on and it's become apparent that interest rates will be going even higher than was thought, then that just increases the crunch. Bear in mind, it was 6 months ago, even the Reserve Bank was talking about a cash rate peaking at 4% or so. Now we're already above that, and they're saying further to go. So this, even though it's, I think, been fairly well understood that we'd hit the bottom in interest rates, the next reset would be higher, it's just that magnitude of it won't have given people much time to prepare. So that's going to require some belt tightening in terms of people's discretionary spending. So effectively the fun stuff once you've prioritised the mortgage payments, and that will have knock-on effects through various parts of consumer spending, and that's a big chunk of the economy. So inevitably, that's would through into a downturn. We are now talking about an outright recession by the time we get into late this year, into the early part of next year. And I wouldn't describe it as a shallow recession. What we're talking about, and it's pretty similar numbers to what the Reserve Bank has come up with, I think similar to Treasury, probably similar to some of the other outfits as well. We're talking something that's probably on the scale of a typical recession in New Zealand. They don't look particularly large if you draw them on a chart, but that really belies the degree of pain that some people suffer from them, and it tends to be quite concentrated. So it's certainly, certainly some people will feel, it might feel shallow. For some people, there'll be some more intense pain. With that slowdown, we do expect inflation to come down over time. Basically, we're not talking about a stagflation scenario. The stagnation will take care of the inflation. It's just that there's always a lag from one to the other. So in the meantime, we're still looking at some fairly uncomfortable looking inflation numbers for a while longer. And there are some factors that will probably be boosting those numbers again for this year at least, even if they just prove to be temporary. And then finally, the impact of the flooding and the cyclones that we've been smashed with in the early part of this year. So this came fairly late in the game for preparing this. We know the impact's not going to be zero, but at this stage, we've had to make some assumptions for it. We'll refine those as we go. But we do have, I don't know if we'd call it fortunate, but we do have a fairly recent playbook for how natural disasters affect the economy. And thinking back, the kind of the years of watching how the Canterbury quake rebuild progressed, one of the things that I'd taken out of that was basically the economy is big and complex, and it's actually surprisingly hard for regional shocks, even big regions, to move the dial at the national level. So while there's certainly talk about, is this going to mean higher inflation than otherwise? Is it going to mean higher interest rates than otherwise? And at the margin, yes, you'd say it goes in that direction. But I think the lesson from the quakes is that the otherwise is far more important and it's far more uncertain. So firstly, just covering off the flooding impacts in terms of what we know or what we think we know so far. Firstly, it's going to be pretty tough to put a number on this. There's a lot of information that still needs to be compiled together. The sense, I think, what we're getting so far is really horrific damage on a localized basis. So there can literally be a farm on one side of the river that got absolutely devastated, one on the other side of the river that came through all right. So people are having to really kind of go property by property to sort of really assess the scale of this, or even just hire a helicopter and survey it from the air. It's a more difficult task than I think, say, with the Canterbury earthquake or the Christchurch quake, where it was, very much concentrated in a city. The impacts varied across the city, but it was quite visible where the worst damage was. I guess the initial effects on the economy. So in the near term, there's kind of two offsetting forces. There's the lost activity. People have been displaced from their homes. Businesses have been shut. There's been sort of lost output, especially in the agri sector. But also the kind of recovery work for that starts off pretty much immediately. So for people who's are not facing a complete rebuild, it's about ripping out the carpets and replacing them and replacing the furniture and so on. So that kind of spending can actually pick up quite quickly. And what we found with the Christchurch quake is that it never actually ended up looking like a net hit to GDP. In fact, we immediately had some very strong GDP numbers as that kind of recovery work actually sort of offset the initial losses. I think this time probably more chance of it being a hit to activity in the near term, just because this time we have had those big losses in terms of the pip fruit, kiwi fruit crops, other vegetables and so on. Whereas with the Christchurch quake, there wasn't really a hit to our exporting capacity. So that's a point of difference this time in terms of how it's likely to show up in the numbers in the near future. There will be some effect on prices. The most obvious ones you can imagine are where we've had crops wiped out. I've kept an eye on the prices on Countdown's website, and the one thing that had stuck out to me so far is it was kumara, which were sort of normally about $4 a kilo. They're now $10 plus, and that's if you can get hold of them at all. I suspect there's a bunch of things that you can't get for any price at the moment. So those kind of things will be boosting the inflation rate in the near term. Some of them are likely to be temporary. Fingers crossed, if we get a normal summer next year, then and a normal crop, then those price rises will reverse and they'll actually be detracting from the inflation rate next year. There'll be other effects like the impact on building costs. So there's kind of this extra surge of demand for building materials, carpets, furnishings, and so on. And in time, insurance premiums, pretty much are likely to go up and not come down in that case. So we don't really know quite the scale of it, but we have made some allowance in our forecasts for inflation being boosted for this year. So what we are talking about is about, I think, still about 5% inflation by the end of this year. If you take out some of the kind of one-off factors, it's probably more like 4%. So certainly an improvement from 7%, still not something you'd be particularly comfortable with at this point. Then comes the rebuild, and this was a huge part of trying to figure out the impact of the Christchurch quakes, and it was evolving a lot over time. What it ended up being in that case was much larger than the initial estimates, but also much more spread out. So it was never sort of as intense at the peak as people hoped it would be for various reasons. So we've made some allowances for that again for rebuild that it's likely to be spread over several years. Difficult to put a dollar amount on it. I mean, I'd say we're looking at single billions of dollars at this point, but it's, I'm sort of reluctant to kind of get more specific than that. So bigger than the Kaikoura quake, smaller, shaping up to be quite a bit smaller than the Canterbury quake, but there's, daylight between those two events. And in the makeup of it, feels like this time compared to the quakes, probably more damage to assets that are uninsured by nature. So it's the crop losses, they're not insured, the damage to farmland, the roads, bridges and so on. So it will be government on the hook for a lot of those in this case. And of course, there's still a lot of decisions that are still yet to be made about how we build back. So if there are areas that need to be depopulated, there's questions about if we have to build roads, if we can't just simply rebuild where the old one was, we need to do the engineering about finding alternate routes and then get onto the building and so on. So there's a lot of decisions to be made that will affect how expensive this job is and how long it takes. And again, a lot of that's going to be sitting with government, so it is difficult to sort of say anything conclusive about those at this stage. Okay, so coming to the lessons from Canterbury. Now, when the quakes happened, the building industry was at quite a low ebb. But even then, you'd also had a lot of capacity disappear. So this was in the wake of the global financial crisis. It was after the legacy of leaky homes. It was after the finance company failures. So there'd been a big hit to the sector. A lot of businesses had disappeared. A lot of workers had taken off to Australia. They might have gone to work in mining instead. So right from the start, there were questions about whether the building industry could handle a job of that magnitude. And even from almost day one, the Reserve Bank, even though they cut the cash rate initially, they also said this is just a stopgap until the rebuild kicks in. Once it kicks in, it's going to be inflationary, and we think we're going to have to raise interest rates again by early 2012. That didn't happen. Certainly it didn't happen in 2012, didn't happen in 2013. When it came to finally raising the cash rate in 2014, they had reversed those hikes within a year because of what was going on with inflation. So in the local sense, yes, there was quite a bit of price pressure on building costs in the Canterbury region. The costs of new home builds rose quite rapidly, and once it had reached that higher level, sort of stayed up there for an extended period. Construction more broadly, though, nationwide, it was much more moderate. So, and to some degree, I guess the Canterbury region was drawing on the nationwide building industry. There were people coming in from other regions, also coming in from overseas. The kind of supply chains were really, I sort of remember the kind of supply chains material for building materials was effectively South Island wide. There was stuff that was being put together in factories in Nelson and being trucked to Christchurch to kind of feed that level of demand. But overall, across the construction sector, much more moderate in terms of that cost pressure. And as for the wider economy, bearing in mind construction is, home building is about 6% of the economy, I think, at best. What was happening with the other 90-odd%? Well, actually, inflation was, for basically the whole decade after the earthquakes, was annoyingly, stubbornly on the low side of the target. And that's because of just what was going on in the wider economy. There was effectively a lot of spare capacity. Now, to be fair, there's no way of measuring spare capacity. It's an important concept. Putting a number on it's really hard. So, take this as indicative. This is the Reserve Bank's estimates of where we're sitting versus our non-inflationary capacity. So it's kind of sustainable output. And it's their estimates as of today. So this is with the beauty of hindsight. They would have come up with something different back in 2011. But essentially, from when the quakes happened, and I guess even when the rebuild started, unemployment was still 6%, 7%. That's not full employment by anyone's measure. As time went on, we still weren't really using up that spare capacity. Even by 2014, when they did start hiking the cash rate, unemployment was still 5.5%. Again, that's not full employment by anyone's standards. So we had still a lot of spare capacity in the economy, not just in New Zealand, in the world. There was this really prolonged hangover from the financial crisis that saw low inflation and some pretty meh growth throughout the world, really. So it's what's going on elsewhere that's really important. And you might say, well, this time's different. We're starting from an economy that is overheated. We're running well above this sustainable output. And that's true right now, but it's not just about what's happening now. It's what does it look like in the years ahead. And if you're thinking, we're going to have this massive interest bill for borrowers, we're going to have a downturn in the economy, unemployment's going to rise, that's going to create spare capacity. So by the time that cyclone rebuild is in full swing, the picture's going to look quite different to what it does today. So I think the thing to take from that, the lessons from Canterbury, is around what's going on elsewhere. Yes, it may be that we get a higher cash rate than otherwise, but that otherwise is really important. And so it's the rest of the session I want to talk more about our understanding of the otherwise. So the story we've been telling for a while now is really about that fight against inflation. And the story in New Zealand is very much repeated across a lot of the developed world. We had a policy response to COVID that led to overheating. We saw unemployment in some places drop to record lows. We've seen inflation take off. And for quite a while now, we've seen central banks dialing that back and actually having to try and fight inflation instead of stimulate the economy. So are we making progress on this? It varies. There are, I think, parts of the world where inflation is reported more frequently. There does seem to be a sense that it's come off its peaks, but is still at pretty uncomfortable levels. So in the US, for instance, inflation peaked at about 9% the middle of last year. It's now down to 6-ish. And all of the progress that they've made there is on the goods side of the economy. So this is as opposed to services. So this is the stuff that I think was always recognised as likely to be temporary. It was your things like commodity prices, rising a lot from their COVID period lows. So oil prices, crude oil went from as low as $30 a barrel during the depth of despair in 2020, rose to $90 even before the Ukraine invasion. So it sort of tripled just because the economy was recovering. If they as long as they don't keep rising at that same pace, even if they just flatten out, which they have, that's not future inflation. That's just a one-off. It's things like the disruptions to supply chains. So where there's been factories shutting down or just, everything takes longer because of greater health procedures. That was a factor that was driving up prices. That's sort of starting to work itself out. It was things like the rise in global shipping costs and the kind of the gumming up of international transport. That's sorting itself out as well. So there's a bunch of things that have seen the goods side of inflation recede, but not so much the services side. The story in New Zealand is we haven't quite seen the moderation on the goods side of it yet. And it may be something that's just lies ahead of us. One example, we have been watching this one for a wee while, is that issue of shipping costs. So on the major global routes, container rates really took off in 2021. So it was that year in particular. It's not the COVID year. It was the year when the world was reopening and people were demanding a lot of physical goods in particular because they weren't traveling. So it was, the kind of cliche of you're not going to take an overseas holiday, so you make home more fun. You buy a spa pool and an Xbox and build a deck and so on. Now, physical goods have to be transported, and so there was a lot of pressure being put on the shipping industry at the same time that they'd cut capacity. So that was the story of 21. That largely reversed through 22. Not because global demand fell off, it was just more the shipping industry got its act together. The capacity responded. But we haven't seen that so much in New Zealand. The costs of bringing goods into the country remained pretty high through most of last year. the last few months it started to tick down again, and hopefully that continues, and we're just falling behind the global trend. But if so, that's something that will help to kind of bring down the cost of imported goods and imported equipment over the year ahead. So it's a nice little disinflationary force that we just haven't had yet. So there are a bunch of reasons why I think we can expect the inflation rate to come down from its highs, but the question is as it comes down, what does it come down to? And that will increasingly be about if I go back here, the purplish part of it. This is, we refer to it as non-tradables here, but it's largely services, and it's often things that are more labour intensive. So it's very much wage costs are kind of a big driver of the inflation there. And this tends to be stickier, has more inertia. This is where you have that risk of price increases perpetuating themselves. So if prices go up, but you've got a tight labour market, if workers are able to negotiate pay rises, it's because, it's usually because businesses are willing to do it because they feel like they can pass on the cost into their prices. And then prices go up, and people come back for another pay rise, and businesses pass it on, and so on and so on. So that's how that risk of that inflation feeding on itself happens. And in fact, I'd sort of encourage you to think about inflation. It's a process more than an outcome. It's not just, prices went up. That happens. And in fact, in a functioning economy, we want prices to move around. It's actually healthy. Where it becomes a problem is when inflation becomes a process of price rises feeding on themselves. It becomes habitual. And a lot of that comes down to you have to have that feedback between consumer prices and labour costs. And you've got to have the right conditions for it. You've got to have a tight labour market. So we certainly have that. Unemployment rate in the low threes is the lowest we've had it in the history of the survey going back to 1986. Probably further back in history, it may have been lower, but we don't have comparable numbers for that. But much tougher than it's been for a long time. And what you hear from businesses, I think, is still that the difficulty of finding workers is still right up there as one of the top issues they're facing. And that's come through in wage costs. Took a little while, as it often does. Wages tend to be the most lagging part of the economic cycle. But it has come through in full force in New Zealand. What I find interesting is that it hasn't come through to the same degree in some of our comparator countries. So Australia, wage growth has picked up, but even if you allow for the idea that maybe they're just 6 months behind in the cycle compared to us, it still hasn't picked up to the degree I would have expected. In the US, there's some signs that wage growth has actually peaked and is coming down again. So I can understand why there's been a bit of soul searching among forecasters about that. Is the idea of a wage price spiral old-fashioned? And it may be true overseas, but in New Zealand, this is, we've got the good old standard textbook response. That wage price spiral is happening. And will continue to happen in the absence of a circuit breaker. And that circuit breaker is typically monetary policy. It's higher interest rates. So that policy response, as I said, has been underway for quite a while now. The first increase in the cash rate was in October 21. But the rates that homeowners tend to favour are usually fixed for shortish periods. So it's 1 to 2 years tend to be the favourites. And those rates are about not just where the cash rate is at the time, where is it expected to be over the next year or over the next 2 years on average. So those rates are always forward-looking. They'll always move ahead of the cash rate itself, and they've been rising since mid-21. So, we're quite a way into it now. But in terms of what people are actually paying, so again, considering that fixing behaviour, you've got a bunch of people that, you may well have fixed 2 years ago at a rate that had a 2 or a 3 in front of it. You haven't been exposed to the rise in interest rates since then, at least not until now. But it's coming. It's just a matter of time. So we went through this, came up with our guesses of how this plays out. I guess at the average level, what's the average rate that people are actually paying at any point in time? And we found that didn't actually bottom out until the middle of last year. So almost a year after the Reserve Bank actually started tightening. We were still effectively getting an easing and sort of more cash in homeowners' pockets. Now that has started to turn since, as you're seeing more people come up for refixing. By end of last year, we estimate that it had risen from low threes to high threes in terms of the average interest rate. But the year ahead gets much trickier. That gradient becomes much steeper. This is where you're going to have the gap between the old and new rates is going to be at its most extreme for a lot of people. And that raises two questions. One is, I guess, the distress angle. Certainly something that lenders are interested in for their own books. I'd say it's probably the media angle that has been taken so far when we've been talking to them about it, and certainly there's been a lot of attention on this that we've found. I don't think that's primarily the issue, but there will be a lot of variation in people's experience of this. Generally speaking, the more recently you got into the property market, the less likely you're prepared for something like this. So you can think about more established homeowners. If we're talking about mortgage rates now, it's sort of in the sixes. I think they're kind of back to where they were in around 2009 or so. So if you took out your first loan at that time, you've already experienced an interest rate like this. You've budgeted for it. You know you can handle it. You've had income growth in the meantime. You might have some savings built up. You might be ahead on the minimum repayments because as mortgage rates fell, you can sort of keep the payment size the same in dollar terms and actually pay off the principal faster. And that's been an option that many people have taken. So there's various buffers that are in there. But even then, the chances are that in the interim, you've probably taken advantage of the world of lower interest rates and you've bumped up your spending in the meantime. So there will still be people that have to tighten their belts to prioritise the mortgage. It may not be painful necessarily, but it still matters for the trajectory of spending on fun stuff. So that's really where our thinking comes into it, is what is the impact on discretionary spending? Because it's not just about, I have to cut my spending a little bit, I'll be okay, I'll just cut back on my takeaway coffees. I've looked at my budget, I spend it. During the COVID lockdown, I think card spending fell by about a third, and I know I'd looked at my numbers and it was about that too. So just not being able to go out and get takeaway coffees just made a hell of a difference. But that's also someone's income and that's someone's job. So it's not just about the adjustment that I do, it's about the knock-on effects that it has for businesses and for employees. Okay, so with that, we're talking about economic activity going from some actually pretty rapid growth recently. A lot of that has been driven by the return of overseas tourists, more so than domestic demand, which was kind of already sort of overheating, and it was sort of a bit of a struggle to find further growth out of it. But we're talking about slowing down, and then by the turn of the year, dropping into a recession. On our numbers, it's about a 1% drop as measured by GDP. It doesn't sound very big, doesn't look very big. COVID lockdown kind of screwed up our charts forevermore in terms of being able to adjust the scale so you can see these kind of things. But in the scheme of things, that's probably about an average sized recession compared to our history. And it may not sound like much. But firstly, this is at a time when we've also got the population growing. So if you put it in per person terms, our numbers work out to about a 3% per capita drop in GDP. That's getting a bit more meaningful. And again, it's going to be really unevenly distributed. This is not just, I'll cut my spending by 3% and I've done my share. It's more like the pain is going to be felt in particular sectors. And it's so for some people it will be nothing, for some people it will be very concentrated, and it sums up to minus 3% economy-wide. Just to put it in context, why I don't call this a shallow recession, it's kind of more moderate sized, is we have had recessions of the size in the past. If you look back, again, they don't seem like huge numbers, but they wouldn't have felt like that at the time. So this is quite a bit smaller than the 2008 recession. That was with the global financial crisis. Probably a similar size to the recession in 97, 98, if you were around to experience that. That was did come along with the Asian financial crisis at the time, but it was also, in our case, triggered by quite a sharp tightening of monetary policy here. So I suspect anyone who lived through that would probably not describe that as shallow or particularly pleasant in any way. Unemployment is kind of ditto. For a recession of that size, we'd be talking about the unemployment rate rising by about 2 percentage points. Given that it's coming from quite a low level, we're talking from the low 3s to the low 5s. Low 5s, again, doesn't sound bad compared to history. It's often been a lot higher than that. But it's still, that degree of adjustment is going to mean some pain for some people. This is equivalent to about an extra 60,000 people unemployed. And again, not evenly distributed. Middle-aged office workers like me don't tend to suffer very high levels of unemployment. The kind who do, it's typically youth unemployment really tends to get the raw end of the deal. Youth unemployment's always higher. It's also much more cyclical than the rest. So it's going to be, the ones who are trying to break into the jobs market for the first time are likely to, be finding it toughest in the next couple of years. Okay, so that's the forecasts. Of course, this is all history. Do we have any confidence that we're seeing that we're on a path like this? So one thing that I've often talked about in terms of, what I'm watching closely to try and sort of gauge if the economy is turning is job ads. So the labour market itself is often considered a bit of a laggard, but job ads are quite a responsive measure of what's going on. So that's that kind of immediate measure of what's the demand for workers. And that has come off. So it's gone in the direction I would have thought. That said, still not particularly low. It's gone from really quite elevated levels to something that's still a little bit above pre-COVID levels. So there's a sense that the mad scramble for workers is easing off, but it's still very much there. And it's not any one particular sector, it's kind of economy-wide, so it's not like it's sort of saying this is coming out of construction or it's coming out of hospital or anything like that. It's more across the whole economy. One thing that could be causing it, I don't think we have a firm answer about this, is the return of migrant workers making it easier to find people. So since the border has reopened, so it was sort of in stages over the course of last year, we've seen the flow of migrants turn from a little bit negative, so a net outflow, to something that's actually seems quite strongly positive. I have some hesitation about the most recent numbers possibly being overstated, but we'll see what happens as they get revised. And the flows have picked up in both directions. So yes, we are seeing more Kiwis going and doing their OE. They haven't been able to do it for the previous couple of years, so there's that pent-up demand to travel. That's happening. It was just the OE was never the biggest part of those flows. The biggest part was always around the arrivals into New Zealand from other countries. And those numbers have picked up quite a lot as well. So that's actually what's swung the balance. Has it helped? I think in pockets it has. If you sort of go around the cafes around here, I think you hear that mix of accents that's been missing for the previous few years and was more like what it was before. Something like, in horticulture, bearing in mind these numbers don't include the seasonal workers. This is people who are in the country for a year or more. So this is not your temporary ones. But there's probably been a few examples where the edge has come off it, but economy-wide, I'm still not really getting the sense that it's that things have eased up a lot. And as I've said before, just got to bear in mind, every person that comes into the country, they may add to the labour supply in one certain area, but they add to demand in a whole bunch of other areas, and that demand has to be serviced by someone, and who's it going to be? So I would still warn that the migration lever is not the panacea to addressing the tightness in the labour market. Ultimately, it has to be around pulling back the demand side of it to get it back into balance. All right, so I'm drawing towards the end. I just want to finish on monetary policy, because a lot of what we do seems to lead towards the views on that. In the near term, it's still very much about the fight against inflation. I think the Reserve Bank understandably wants to keep up that message that they will do what it takes to bring inflation down, over a reasonable horizon. For now, there's still some pretty ugly numbers, even in people's inflation forecasts for the year ahead or so. So they're talking about further increases in the cash rate in the near term, at least. That is probably at the least, it's really just about making sure that financial markets don't get ahead of themselves, start pricing in the next phase, start pricing in OCR cuts, borrowing rates come down, and then potentially sort of re-stimulating spending and re-stimulating the property market before we're really sure that inflation has been beaten. So that's their message for now, and I think that's also behind their message that rates will need to stay, at a high level for a while. It is still very much a cycle. We're kind of in agreement on that one. This is not about interest rates are going to be permanently higher. This is about we have an inflation problem. Interest rates need to be high for some time relative to normal, whatever normal may be. But they've got to be high for a while, then they can come back to normal once we've got on top of inflation. So it's still very much the cyclical aspect. Where we, don't share their projections at the moment is around how that next leg of the cycle looks. They have quite a delay before they start releasing the brakes. But I want to come back to that earlier chart I had with the effective average mortgage rate estimates. So I kind of talked about the upside of it. So what's happening when the Reserve Bank's trying to tighten policy. But that idea of monetary policy working with a lag applies in both directions. So once the Reserve Bank starts to take its foot off the brake, it'll still actually take a while for the brakes to disengage. So on our estimates, now this is with our assumption of cuts in the cash rate through 2024 and beyond. Even that would be that's just what it would take to stop that average mortgage rate rising by 24, let alone providing any relief to homeowners. This is just about how long does it take to stop squeezing households. If we plugged in something more like the Reserve Bank's track, that red line, the average rates that people are paying, is going to rise higher, and it's going to take longer to settle. So this is not something that the Reserve Bank will be unaware of. They've done the same kind of analysis. They'll understand that they've got a sticky brake pedal. And so to avoid a deeper downturn than is necessary to do their job, they would actually need to act quite early and start reducing the cash rate long before inflation is actually back within the target band. They've got to really be thinking about that kind of what do things look like in 1 to 2 years ahead. So I'm on the side of saying I think they will do the right thing. They will be aware of this. They have been quite proactive so far in recent years, both in terms of their willingness to boost the economy during COVID, rightly or wrongly. They were quite active about doing it at the time. And also, once they did realise inflation was the problem, they moved pretty shortly after that. So they are willing to move early with an eye to where they think we'll be in the year or two ahead. So that's why we land with this forecast of them cutting what seems like quite hastily, but it's actually just really reflecting the fact that it takes a long time for these things to flow through. That said, I would say, relative to our view, the risks are certainly towards later cuts rather than earlier cuts, with the correspondingly greater risk of a deeper downturn than we really need to get inflation under control. And maybe even we ended up with inflation being a little too low for a while. Might be a nice change from recent history, but it would come, again, at substantial cost to activity, to employment. So there is very much that balance to be struck there. Okay, I'm going to finish up with my part. I'm now going to pass over to Imre, and he's going to give you the rundown on financial markets.
My job today is to take on board all those great macroeconomic insights delivered by Mike and the economics team. And I have to say, the Westpac Economics team has long been a very strong team and made the life of a strategist much easier. Not easy, but easier. So yeah, very, very, very useful, taking on board all of that good stuff and then combining it with other elements. we do come up with our financial market forecast for the currency and interest rates, and they look like this for the next 3 to 6 months. We're calling Kiwi US maybe for the next 1 to 2 months lower still, but then somewhere around the middle of the year, give or take a month or two, a reversal, and that reversal should persist into the end of the year and even right into the next year. The Kiwi Aussie, over the medium term, we're forecasting that lower, mainly on China-related matters, and interest rates largely sideways like we had for the previous quarter, both short-term and long-term rates. Not too much to see here, we think, and the yield curve probably of a similar shape, but eventually tending towards a steepening, and that's what we're preparing for from about the middle of next year, of this year. So, going into a bit more detail behind each of those things. The Kiwi US forecast, and looking back to last time, because everybody wants to know, what did you say last time? Right, wrong, good, bad? You have a look, those are the arrows we put up. Not too bad a job. Last time around it was really all a US dollar story, not so much a Kiwi story, and that's the same for the quarter ahead. The really big number one topic in global markets is how high are these rate hikes by the Fed going to go? When will they stop? And that affects everything else. And that really is still the number one story, and it's driving the Kiwi US exchange rate. The up that we had up to about 65 cents, and then very recently the fall, what that has been is just an assessment that, gee, Fed's really hawkish, rates are going to go a lot higher in the US. And then we had what the market perceived as other way around. We had a pivot from the Fed, or a perceived pivot, where the market thought, oh, the Fed's actually going to slow down because they're worried about putting the economy into a recession. So US dollar suffered and Kiwi rose. And then very recently, we had an emphatic Fed, Chair Powell, coming out and saying, no, we're resolute and we're going to be really hawkish and hike a lot, and we've got a big inflation problem. So market swung it around and pushed up the US dollar, and hence Kiwi US fell. So we're in that iteration at the moment where the Fed does look very resolute. The next 3 weeks are critically important to this outlook. We've got 2 big data points, one this Friday, US jobs data. Next week we've got US CPI data, and then following that we've got the very important Fed meeting where they'll hike rates, and they'll tell us what they think rates will do over the next few years. They'll update their projection for the Fed funds rate. So a lot of good info, and there'll be an economic forecast coming out as well. That, I think, will set the scene for probably the next few months. It's going to be a very, very important meeting for anything to do with the US dollar, and US interest rates, and that's pretty much everything in the world. So watch out, next 3 weeks could be quite turbulent. Way we think it will pan out, putting our best crystal ball over the thing, is that the data in the US should be US dollar supportive. It'll be sort of as strong as we've had lately, which has been pretty strong, both jobs and inflation, and we think the Fed's going to be pretty tough talking at their meeting, and they're going to raise the peak projection for their Fed funds rate by probably another 50 basis points, if not more. So yeah, markets, I think, will respond to that. They'll push interest rates up, and they'll push the US dollar higher, and all currencies against the US will fall, including the Kiwi. So that's the near term, next 1 to 2 months maybe. Beyond that, eventually that story has to tire and give out. And, the hard bit's wondering exactly when that happens. Our best guess is somewhere around the middle of the year. That Fed is well and truly priced, if not overpriced. And then thoughts will start to turn to, well, gee, yes, they've hiked a lot, like other central banks have, but now these economies are all going to start to feel the lagged impact, and the US, because it's had such an aggressive tightening cycle, should feel a fairly noticeable impact. And it may well underperform big blocks like the Eurozone. And that, if it pans out that way, should give rise to a broad-based selling of the US dollar against most major currencies. And that effect will ripple through to the smaller major currencies like the Kiwi, and that'll push the Kiwi US up over the second half of the year and into next year. And if you just need a reminder on how close we are correlated to the broad-based US dollar, there it is. It's almost a mirror image. Yes, it's always a mirror image because the US dollar is so dominant, but lately that relationship has been even closer than usual. In other words, the Kiwi-US market is saying it's all about the US right now. The Kiwi stuff doesn't really matter so much at the moment. It's not that important. And if you wonder what the fair value for the Kiwi-US is, it's about 64, so it's slightly undervalued. Is that alarm bell undervalued? No. If it got down to about 59 or 60, it would be. And then our valuation models would be saying, hey, this is way too stretched. It's way too undervalued. This is one reason why you might want to think about buying the Kiwi, but that's a story for about 3 months down the track. Kiwi-Aussie. To date, this has really been all about RBA versus RBNZ. So where those two central banks are in their stances, which drives the interest rates in those countries, and therefore the difference between those rates, which determines where this cross goes. We've had a few, I won't call them U-turns and flip-flops, but we've had a few different iterations on RBA versus RBNZ over the last year. Looking at it with a sort of an overview lens, the RBA has been slower to start than most central banks, and it's been pretty slow to move. It's been one of the more reluctant hikers compared to the RBNZ, which was right at the forefront. So that benefited the Kiwi for a while. You can see that was the big upturn over the last quarter. And then the pullback was when the RBA recognised via some of their own inflation data that, gee, they better get cracking and start hiking rates a bit faster. And the market jumped on that signal and started pushing the Aussie up as a result. So we saw Kiwi-Aussie falling. Where we are now is we've had another bit of a flip. So a couple of days ago, we had the RBA meeting and they surprised everybody by, they hiked by 25, but they signalled that they might start pausing soon. That took everybody by surprise. And that's caused a wee bit of a bounce recently, which might persist for the next few weeks, maybe a month. So I've got a wee up arrow there. Beyond that, though, I think this relative central bank story is getting pretty mature. We're both getting near the end of our cycles, and certainly by mid-year, we're both done. What will the new story be that drives it for the rest of the year? And it should be the Chinese economic recovery. So China's coming out of a couple of years plus of very severe COVID restrictions to their economy, and also curtailment of certain sectors like the property sector. Those are being loosened. In fact, well, the COVID ones have been completely loosened, and they're targeting now revival of sectors like the property sector. We think the Chinese economy is going to do pretty well for the balance of this year and next year, and that'll become increasingly noticeable, and their markets will jump on that, and they'll buy the Aussie over the Kiwi because the Aussie dollar is far more sensitive to Chinese economic matters than is the Kiwi. So that's our main story there. Chinese recovery, if we're right, equals a lower Kiwi-Aussie cross over the medium term. And on interest rates, last quarter was indeed, as we thought, a sideways range. More of the same for the next quarter, and then possibly towards the end of that quarter, a start of a movement downwards. So why is that? Why are we so confident that we'll probably stay in a sideways range for, say, the next 2 months? Markets in the near term look pretty well fairly priced. And the way to see that is the black line on this chart is the market's predictions for the OCR over the next many meetings over a 2-year period. You can see over the next 12 months, markets are almost perfectly in sync with RBNZ forecasts and the Westpac OCR forecast. There's nothing to see there. If there's no surprises from the economy or other events which are relevant, then the market should not move. It should remain stuck here. Of course, we're going to get surprises, but this is really the basis for coming up with a view that probably sideways with a bit of fluctuation in a range. A bit further ahead, though, if you go out 2 or 3 years, you can see there is quite a bit of divergence, and the market is well above where Mike and team say the OCR is going to go over the next few years, which is downwards, down to 3%. Now, that's a big divergence. That's not going to play on the market's mind for a while yet. I think the market's so preoccupied with trying to figure out exactly when will all these central banks stop hiking? What will the top be and how long will they hold it there? You know, that's the big guessing game regarding the Fed. It's also a big guessing game regarding the likes of the RBA and RBNZ. So while that is the preoccupation of the markets, I don't think they're going to give too much attention to trying to price in the next easing cycle, which kicks off early next year. But at some point they will. And when will that be? Well, at least when these tightening cycles are finished, which should be around the middle of this year, probably a wee bit beforehand. Once the central banks start giving a signal that, for example, here's a hike, and that's probably the last one. There's a signal, market will run with that, and I'll think, gee, we better start pricing in the easing cycle, which is the next big thing, and that's when you'll see that black line starting to drop away, which will push down your 2 and your 3-year interest rates. We often get a question, swap rates and even fixed borrowing rates, are they expensive or cheap right now for various maturities? One way of answering that question is to convert the Westpac's OCR forecast out for 10 years. Yeah, gee, that's a long time with a lot of uncertainty at the back end, but we've got one. We've got a 10-year forecast. Convert that to swap rates and line them up together, and this is what you get. You can see by eyeballing this that the first 3 years or so look about right. We'd call those rates fair. Further out, they look expensive. That's the takeaway here. How do you use this? If you're considering borrowing fixed rates or hedging your liabilities, this is something which might help inform that decision. Now, when I said these short-term swap rates should be in a sideways range, barring any surprises, where could the surprise come from? Of course, it can come from anywhere. Where's it most likely to come from? I think it's going to be offshore. As I said, the Fed guessing game is the biggest game in town right now, and that does influence short-term New Zealand interest rates. Even if nothing's happening to the economy here, if there are no changes, if we get shifts in US short-term rates, they will cause shift in New Zealand rates. So very important to pay attention to or follow what's going on with US short-term interest rates. And as you can see here, they co-move pretty closely. In the very recent iteration, you can see that red line, which is the Fed pricing, surged. And that was following that Fed's new talk tough stance. So Fed pricing surged and New Zealand rates went up with it. Even though at the time, there was nothing going on in the New Zealand economy to justify that, they went along for the ride. So be aware that that's a place where you could get surprises still. And as kind of Mike touched on a bit, the direction of a surprise, probably more likely to the upside than the downside. And I say that because so far the pattern has been that everyone, including the markets, have really underestimated how strong this inflation problem is, including the Fed, and continue to ratchet up their degree of hawkishness as a result, and therefore markets that have ratcheted higher. So that's been the pattern to date. So I'll run with that and say the skew of surprises is likely to be to the upside. And finally, another reason why markets are following the Fed more closely than they usually do is because in this particular cycle, the Fed is the most aggressive hiker in the world. You can see that by taking all of the major central banks' hiking paths to date and starting them at the same time. And you can see that the Fed's hiked the most along with New Zealand, but the Fed's done it much quicker. So not only is the Fed the biggest central bank in town, therefore very important, but in this cycle it's been the most aggressive, and therefore one should be watching them for clues as to what could happen in other jurisdictions. Winding down, we've now got the long end of the curve 10-year rate, which we said sideways range last time. It was about a 100-point range, and people laughed at me and said that's not much of a forecast. Well, that's what happened. We've got a 100-point range. So I'm going to run with that again and say 100-point range again sideways. Risks in both directions to that I think are possible. So you could get a more severe recession earlier than people expect, in which case long-term rates will break to the downside. I think more likely, if there's a breakout that range, it'll be to the top side. Again, for the same reasons that inflation proves much harder to control than central banks and markets give credence for. And so, yeah, I'll be watching out for that. And finally, just a word on the yield curve shape. Right now, the wholesale yield curves for swaps and bonds and mortgage rates and other things are inverted. And it's a slightly weird situation where you've got short-term interest rates higher than long-term interest rates. That's not a normal shape of a yield curve. Why has that come about? Simply because this tightening cycle in New Zealand has been much more aggressive than usual. So usually what happens is, well, we go back to 2 years ago, you've got a very nice shaped, positively sloped yield curve. That's almost textbook in shape. Then we start our rate hikes and it goes up a bit and it's still a positive shape. So that's still kind of textbook-ish. Normally, if it's a moderate hiking cycle, that's the shape you end up with by the end of it all. In this cycle, because the Reserve Bank's been far more aggressive and it's kept going more than it usually does, it's pushed up that front end a lot. And you've ended up with a really anomalously looking hump at the front end. So that's where we are now. Looking ahead, even beyond 6 months, really to the next year, we're reasonably confident that the yield curve's going to steepen. So that hump's going to disappear, the inversion's going to disappear, and essentially the whole thing's going to move in reverse. So the whole thing will deflate, everything will kind of fall, the front end will fall the most, and you'll end up with a shape somewhere in between the very bottom one and the next one above it, I think, when it's all said and done. So when will that process start? Probably around the middle of the year, but it's something that we're increasingly talking about as kind of the next big thing in interest rate markets, the looming steepening of the New Zealand yield curve, which will last for quite a while. And with that, I'll finish up